Understanding the income statement. The income statement is tasked by showing the profitability or loss of a business during an accounting period and the drivers formulating it. Analyzing the income statement can uncover insights and further provide recommendations for operational, investment, and financial decisions. In this video, we will introduce the P&L 5 main checkpoints an analyst should use in vertical and horizontal analysis. The checkpoints are calculated and analyzed in chronological order to understand the drivers of performance. 1. Gross profit. 2. Net operating profit or loss. 3. Earnings before interest and taxes. 4. Earnings before taxes. 5. Net income or loss. The first point is gross profit, and it is calculated by deducting the cost of goods sold from revenues during the same accounting period. Cost of goods sold include the direct costs associated with the production of units or services sold, as well as other non-cash costs allocated from productive assets utilized, known as depreciation and amortization cost. The second point is the net operating profit or loss, and it is calculated by deducting operating expenses from gross profit as well as adding secondary operating income consequential to the main course of operations like subsidies and rebates. This includes salaries, marketing, distribution, general and administrative expenses. Net operating profit allows analysts to comprehend the financial health purely resulting from the normal course of operations. The third point is EBIT, and it is calculated by adding non-operational gains and deducting non-operational expenses from net operating profit or loss before measuring financing and taxes impact of performance. Non-operating income include capital gains and dividends, while non-operating expenses include foreign currency losses and impairments. EBIT allows analysts to reconcile the impact of external factors like exchange rate changes, provisions, impairments, and capital gains or losses to the normal course of operations. The fourth point is earnings before taxes, and it is calculated by adding interest income received from marketable securities and deducting interest expenses paid on loans. Hence, adding the impact of financing and investing decisions to operational performance. The last point is net income or loss, which is calculated by deducting the taxes expenses due payment from the earnings before taxes. The net income or loss is the net sum of all operational, investment, and financial performance that took place during the accounting period, which can be indexed to management decisions previously taken. Breaking down the profit and loss statement into the 5 checkpoints normalizes the comparison and analysis of operational strength and weakness between peers in vertical analysis, or across time for the same company in horizontal analysis, allowing analysts to recommend corrective actions and insights, and provides the C-suite with informative decision-making. Follow Femto and activate the bell for more FP&A educational content.